Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust or 1031 exchange is the best way for you to grow your wealth. I'm your host, Brett Swarts. In each episode, I'm joined by some of the best financial independents and passive income wealth advisors and or professionals in the world, where they share their ideas, deal stories, and inspiration, so together we can make complex tax deferral strategies simple and passive income plans achievable. Our next guest is actually a client and friend of mine. I've known for a number of years now. He's a serial entrepreneur, very successful in the Silicon Valley in multiple tech companies. He's actually the president and CEO of Everflow Technologies, which helps provide smart tools for digital marketers. As well, he's an expert in owning and managing and operating commercial real estate, at particular multifamily in Northern California, through value add forced appreciation strategies to increase cash flow as well as appreciation for deals. And so I'm really excited to bring him on the show. And so please welcome to the show, Kanwar. And Kanwar, I want to make sure I pronounce your last name correctly. I don't even want to do it. I want to do it justice. So Kanwar, how do you pronounce your last name?
Dhaliwal.
Kanwar Dhaliwal. So Kanwar, welcome to the show. How are you today?
I am very well. Thanks for having me.
Excellent. And would you give our listeners a little bit about your story and background and then your current focus?
Sure. So I originally am from the Midwest. Grew up in the Chicago area, went to university in Illinois, moved out to the West Coast. My first job was in Sacramento with the chip company Intel in Folsom. And I spent about a year and a half there. Then this is around the year 2000. This is 3 boom bust cycles ago, since we are kind of on the downdraft of the third one in my career. And so I moved from Intel, I moved to Silicon Valley in 2000 and, lived through the dot-com crash, survived and lived to tell that story, lived through the housing and the financial crash in 2008-9, and now we're going through this. So, throughout I've been a serial entrepreneur. I've started multiple companies. And as you already laid that out, I currently am a founder at Everflow Technologies. And also I am a pretty active real estate investor, and my strategy is generally value add as well as buy and hold quality assets as much as possible.
Excellent. Love that background. Thanks for sharing. And just curious, before we dive into some of the kind of the details and some of the conversation today, I'm curious, who was Kanwar growing up? Besides being from the Midwest, I believe we've all been given certain gifts in life, and maybe that one particular gift that really that sticks out to you that you kind of recognize as a child growing up or as a teenager. What was that gift, and in particular, how has that gift helped how you help others today?
Sure. So I think I've had 3 big breaks in life. I would call them 3 gifts. First, I was, of course, being born into a very loving family. We were a middle-class family, very educated, but very middle-class family. Second gift was, at a very young age, the opportunity to come to the United States, which, again, in hindsight, definitely qualifies as that. And then third was meeting and marrying my wife. Those are my 3 big gifts. And each one has grounded me, taught me, put me through a test with a high bar that I always strive to achieve. And what I do with that, I think I have a soft corner for, just like society does in general, but I certainly have a soft corner for people who come from humble backgrounds and are willing to work and learn and improve upon themselves to get to the next level. So everything I do in my spare time in terms of helping people is really governed by that belief system.
Excellent. Love that about humble beginnings and kind of a lower income background. That's my background too, so I can certainly relate. So curious, when did you become fascinated and or kind of focused on achieving freedom with real estate investing and or passive or active income?
So that was literally about 4 years into my career. My first real estate deal was a single family house I bought in the Phoenix area back in 2003. I was, very young, very early on into my career. At that point, I had no I didn't think I had any ability to buy anything in the Bay Area, which is where I was working. So, that was my first foray into it. It wasn't a very big deal, but, it was something that taught me a lot. Read Rich Dad Poor Dad back in those days, and that really kind of crystallized a lot of my, thinking. And so that was my, first deal, I would say. And then, from that point onwards, what occurred to me was that over time, I wanted to not be tied to working in a job where I have no control over my destiny, because booms and busts come and you're literally getting yo-yoed. And the further down the food chain you are, the more whiplash you see. And I wanted to, basically get out of that cycle. And that was really the motivation.
And thanks for sharing. And that's so true, right? Kind of controlling your own destiny, creating multiple passive income streams or active income streams, and really not being dependent upon one single form of investment, which speaks to, diversification and because sometimes, multifamily is doing great. Sometimes the tech industry is doing great, and vice versa, or different things. With that being said, you've been through multiple kind of let's say recessions or crashes, if you will. I'm curious, how does this newest one with the Corona crash compare to those other two? And what are some of the questions you think that, individuals should be asking during this time?
Sure. Actually, I would say instead of 3, I would say there's 4 crashes. We had 2 back to back. We had the dot-com crash in 99, 2000, and then we had 9/11. They kind of tend to get clubbed together. And then we had 2008, which at that time we said, okay, this was an 80-year recession, right? Which is what it was. And now the current one. We, obviously there's no official prognostication about a recession. We know absolutely it's going to be one, and it's going to be a deep one. We just don't know how long. What's different about this one is it's a recession that there's zero precedent in history about this. In modern history, we've never had a situation where consciously the authorities collectively worldwide have decided to just turn off the engine and throw the keys out. All recessions have been a systemic dysfunction of some sort. Either there's too much debt, or assets are dysfunctional, or consumers are over leveraged, and there's a slowdown and there's a reallocation of those assets into healthier situations, and then the system emerges from that. So that's why I think this is unprecedented. We're waiting and watching and learning every single day, almost every single hour, it seems, to see how this is going to shape up.
Yeah, it's really interesting that you say that. And, I found that it's tend to hit us on just so many levels all at once. It's like a bomb blew up, and, the social part of our lives, and the events and the entertainment. And then of course, the health is the number one thing, the scare of the health. And then of course the economy, and then there's the stock market, and then there's jobs, and it's all at once, and it's worldwide. So it seems, very unprecedented. That being said, what are some of the either the measures or some of the things that we should be asking ourselves to either prepare for this in the future, or make some adjustments, because it just doesn't seem like it's sustainable to keep millions and millions of people. I mean, the job report came out today. Today's April 2nd. 6.4 million people filed for unemployment in the U.S. So, I mean, how do you sustain? At what point does it the solution to this outweigh all of the consequences?
So that's obviously what the president has brought up a few times, and many other people have brought up privately. The solution, I think, will reveal itself over time, but few things are really apparent. One, I think the system needs to have more slack in it. If we have a society where a large percentage of the population is very paycheck to paycheck, and the moment the tap is turned off, there's absolutely no slack in that. And that is catastrophic. And, trying to coax people into being more disciplined is one thing. I don't think that works. It's certainly not been proven to work that well. However, there are systems in place. We have lots of sectors of the economy where people are forced to pay into a retirement plan, forced to pay into a saving plan. Companies in the past have been forced to have certain reserves. So that when I talk about slack, I'm not talking about just consumers. I'm talking about corporations as well. Airlines come to mind, and many other sectors we can talk about come to mind. So I think some sort of a legislative action that forces some slack buildup in the system is very important, so that it's not that if we decide to, we want to have the option as a society to be able to turn the switch off for a month and not face catastrophic things. That's not that much to ask for. I actually do very simple math on this. The US economy is 21 trillion. That's about 1.75 trillion a month. If you were to turn the lights off completely, essentially that would shave off about anywhere from 30 to 40% of the GDP, because your electricity is still going to be on, utilities are still going to be on, very essential services are going to be on. And a lot of the services businesses that can be done from home, like my work, can continue to be on. But about 40% of the workers that are not capable of working remotely will be affected, right? So that is something we should be able to handle, right? So these are things that I think need to be addressed as a solution to this going forward. Obviously, this is hindsight based on what we know now, but I think we know enough to know what we should be doing going forward. Another thing I think that's worth bringing up here is less dependence on things we have no control over. Okay, so when China got hit by this virus, they have the pole position on the supplies. They're obviously going to hoard those supplies, and you can't even technically say, hey, that's wrong, because that's what they would do. That's what we would do. But what we can do and should do is not have dependency on about core things that we don't control. So that's defense, that's healthcare, that's food, and that's energy. I mean, I think these are the four big sectors.
Yeah, so well said. And a couple things kind of come to mind when you're talking about dependency on core things, right? So there's the U.S. economy, right? That's dependent upon and has the debt with China that we've already been facing. There's this world of automation that was already fastly taking over a lot of things even before Corona, right? And I sort of see this as another wake-up call. And with every crisis, there's an opportunity. And part of that opportunity is preparing for what could be 10 or 15, 20 years from now. What does the world look like as technology and automation take a lot of that 40% of those jobs, let's just say? And what do we do as a society to prepare for it? So I think it's speeding it up in a way, or it's showing where things have been exacerbated, where things are stressed or dysfunctional, if you will, for the future. So could you, being in the technology world and being a tech entrepreneur, would you just speak about your thoughts on automation and the way things are going just in the world in general for the future?
Sure. Excellent question. I'll start with one example. 200 years ago, give or take, almost everybody, or 90+% of the people, maybe take 300 years ago, were somehow in some shape or form involved in food production. Either they're farmers or they're traders or they're transporters or they're retailers or they're preparers, right? And we still didn't have enough food. Okay. Today, less than 2% of the workforce works in farming or agriculture or anything associated with agro industry, and we have excess food. We have tons of food, right? Our obesity crisis is a proof of that. So the point I'm trying to make is all of that is because of automation. We have combines and we have tractors and we have threshers and we have all these things, right? That certainly didn't put people out of work forever. Surely there are moments in history where a big revolution happens and it puts a lot of people out of work, and some of them who are at the latter half of their careers find it hard to adjust, and that's unfair. And I think there are measures that can be put in place to help them and adjust with them. But I don't think the saying no to automation is the answer, because in the end, the reason we live, an average person lives a lifestyle today that royals from a few hundred years ago couldn't dream of, is because of automation, right? So that's my take on automation. How do we go about making sure that society is adaptable? I think we take some of the interventions that government does in many cases, and media promotes in other cases, out of it, okay? And I'm going to touch on a topic which tends to be a lightning rod, but I think this is the right time for it to be brought up.
Please do.
I think we have a higher education bubble in our society. We have pitched to an average American high schooler that college is a 4-year college, as fancy as possible, is the only path. And that's not true. A functioning society needs a lot of skill sets. Some of them are very high-paying, profitable skill sets that don't require college. Okay, college is a 4-year hangout time for many people, right? And I don't mean to diminish college. All I'm saying is that there's a right place and right time for the right person to do the right thing. And one size fits all makes for ugly clothes. So what we've had is we've had the government backing college loans and pushing a lot of people into universities and into these disciplines where there's no ROI. In real estate, we talk about ROI. We always talk about ROI. We talk about cap rate. We're so numbers oriented. Why are we not that there, right? Since we're talking about automation. We've got colleges that today that look like resorts in terms of, their dorm rooms and facilities and all that. The university I went to, University of Illinois, I paid out-of-state tuition. That was $9,000 22 years ago, a year. That was expensive. I paid out-of-state. And today, that university is $36,000 a year. What has gone up in price 4x? Not cars, not food, maybe not even gasoline, right? So I think what we have is too much intervention, and that's that's actually preventing society from adapting to these changes. People will adapt very, very quickly. There are a lot of trade-based jobs and a lot of other jobs that pay a lot of money. I think we need to promote them fairly. And I think what we're doing is we're distorting the market with this.
Yes, so much meat there to look at and consider, and I just can't think of a better way but to give more freedom to people and more transparency to people, right, and more options for people, because we will adapt, we will adjust, versus a big government controlling a lot of things. Not to say there shouldn't be regulation, there shouldn't be incentives, and there's a place, but you're right. I think education in particular, the student loan crisis, which the trillions and trillions of dollars that are out there that could be, who a lot of people say even bigger than the housing crisis was, right? And part of it is these loans are not forgivable, right?
They're not forgivable. Very good point. And I think when we talk about tax, we talk about tax optimization, we talk about so many things, and I think this is one of those things that's a ball and chain. It's not forgivable. And I'll make one other point, which in my mind, it nailed it. Any loan you give anybody against any asset, in this case, asset is an intangible knowledge that you have that can't be taken away. That's probably why it's not forgivable. If you make the university co-sign it, let's see how many universities are willing to take those students on at exorbitant price levels and handing them degrees that are not going to have the ROI.
Yeah, well said, right? Put your money where you're accepting all of these loan dollars from, right? Because it's I guess on the American people per se, because it's not forgivable, or it's just on that family forever. It's really a house of cards, which is kind of scary to think about for those. And it also prevents those from, debt creates a sense of slavery, right? You're basically a slave to the lender, and it can prevent you from starting a business. Or B, you end up losing your house because you're depending upon one source of income and you have all this debt, and now you lose the job and now everything falls. There's so many things about debt that are not good. Now in real estate, debt can be very good if you can buy at the right time and leverage well and make sure that the asset itself is producing that cash flow and you can add value, which is another reason why I'm so probably you, so passionate about investment real estate, and wish that everyone could learn just the beauty of what that is and what kind of freedom that can provide. But that being said, we're in a marketplace now that is shifting rapidly. I mean, we just saved a failed 1031 exchange last week for a gentleman who sold a $7.6 million property, and he was about to buy something, but then the corona hit and everything kind of fell apart, and he decided for the first time in his he's doing it for like 30 years to do a deferred sales trust, and he moved his funds in there, and part of it was to get out of debt and to get liquidity, so and get some diversification and buy when the market makes sense. But could you speak to just that, the importance of diversification, liquidity, and staying out of debt at a time like this?
Absolutely. I think debt, as you mentioned, is a healthy thing when used and managed well. That means your debt coverage ratios, your loan to value, your whatever the metrics are need to be healthy. And I think what we've had at times, and I think one point that actually is interesting, is going to be interesting to watch, is multifamily real estate, in my mind, is one of the more, if not the most durable asset classes. Okay. Because on the Maslow's hierarchy of needs, it sits at the bottom. It's food, it's shelter, it's clothing, it's all those things, right? And that's the last thing that people will give up, right? Maybe they'll taper it down. Maybe people will take in a roommate. Maybe young people can move in with their parents, but generally that's always going to be there, right? So it's a very durable asset class. But from an investor's perspective, you have to manage it well, right? From a leverage perspective, from a cash flow perspective, and so forth. And I think what we've seen in recent years is as there's been more demand, household formation, economic growth, wage growth, which was starting to kick in over the last few years, you saw a clear pressure on rents going up. And I think that was driving a lot of activity, a lot of syndication. And I think, my strategy, as I mentioned earlier in the intro, has always been to buy and hold, which by definition has meant that I've never had aggregate loan to value ratio north of 50%, right? So this is about as acute of a stress test you can have to a system, right? You can't imagine anything worse. And I don't think it really matters to me, right? So that said, I think it's very important for people, I think, who were at the very high end of that ratio, the most the system would allow. I think then this thing tends to become a little touchy, right? So I think it's all about, when I started in multifamily, I mentioned I started in real estate back buying single family homes a long time ago, but let's say multifamily, I started in 2011, late 2010, 2011. I still had a lot of scars from 2008. Okay, 2008 and 9. Every deal I would do so conservatively because my mindset was governed by what I had learned there, right? If somebody started in 2017, 18, 19, I can very easily imagine how their mindset is completely different, right? Because those things are not fresh in their mind. So I think that's where it is. When you enter into the market, generally in any market, I could say that for the tech market, my last company that I'd started was at the bottom of the 2008 recession, right? It was easy to hire people. You could hire them at a reasonable price. And if you had a good quality service, then you also had a good pitch to the customers. And same goes for real estate. I think entering at the, in a market downturn, as much as it's hard to fathom, is generally the best outcome if you can pull it off right.
That being said, where do you think the tech industry, how is it going to fare given what's going on? And even before Corona, where was it as far as, health-wise, as far as, earnings, as far as values, as far as, workforce, as far as just growing its own economy? Because the Silicon Valley is such a unique place. So would you give us a little context about where it was before and where you see it going now given Corona?
Yeah, so tech industry has many sectors to it, right? You have, companies that manufacture semiconductor chips, and you have companies that make gadgets and boxes and devices, and then you have companies that build software. So there are different sectors. So software as a service, that's called SaaS, SaaS, or platform as a service. We'll take Zoom, the service that's powering this thing right now. Their stock skyrocketed because all of a sudden, they are the company that's powering, one of the few companies that are powering this work from home revolution, right? Or work from wherever revolution. So there are sectors in the tech industry which are absolutely skyrocketing. E-commerce is another one. People are shopping online, right? People are shopping online, and Amazon being the big behemoth, but then there's many others who are able to deliver their products in a timely manner to wherever they are. Amazon today has 110 million Amazon Prime subscribers in the US. That's almost 90% penetration of US households, right? So there are parts of tech which are absolutely benefiting from this, because attracting new customers is very difficult. It costs a lot of money, and this thing is actually driving people into those arms, right? And once you become a customer of it, you don't let go easily. So it's a very sticky service. So tech broadly, I think, is benefiting from this in a very, very big way. Obviously, there are sectors that will suffer, right? And generally, that's the froth that gets blown away with the first draft of wind, right? I mean, you have the scooter rental companies and all these other gimmicks, right, which were never profitable. The unit economics were not profitable, right? And if the unit economic, which is if you're selling something for $1 and that thing costs you more than $1 to make, spending more money to acquire more customers is just going to expand your losses, not your profits, right? So I think it's a shakeout. I think it's a cleansing event, but broadly, this is very, very good for tech.
Well said, and thank you so much for sharing. I want to shift to a question, just really focusing on maybe the top one or two top reasons or top ways to build wealth in real estate and or to defer capital gains tax. Yep. Maybe walk through a little bit about how you've done that so far, and maybe touch on 1031 exchange, touch on cost segregation, and walk us through how you've been able to use capital gains tax referral strategies to defer tax.
Sure. Absolutely. So my first, I'll start with my first multifamily deal, which was in 2011, and that was again at the bottom of the market, and that was in the East Bay, in the Bay Area, and it was an all cash deal. I literally took 90% of my net worth at that time and bought it in cash with a partner, and that was a big, big call. And at that time I felt very insecure about it. But anyways, we got through it and were able to refi once we stabilized it a few months later, and then went from strength to strength from there. Bought another deal nearby in the Bay Area. And then, once me and my partner at that time, who were still, partners, we decided that, okay, maybe Sacramento is a better market because we could achieve more scale, and it's a good blend of cash flow as well as value growth, as well as growth and cash flow, right? I mean, you have markets that are very cash flow focused, but they don't have growth and value, and then you have markets that are just like stocks. You have very high P to E ratio. So in these markets, we have very low cap rates. They're predicated on continuously growing valuation, but not a cash flow. So we felt that Sacramento was an incredibly solid market. It's a big city where you have a real job base. It's not a satellite to another city. It is also very uniquely located on the 80 corridor, and basically started to double down and grow in the Sacramento multifamily market. Every single purchase was essentially a 1031 exchange. You and I have done deals where they have been 1031 exchanges. And the only time I have sold something that has not been a 1031 exchange was because of cost segregation. So that was last year. I was able to divest one property simply because it was a bit of a management headache, and I basically was able to defer that with cost segregation. But it's always been 1031 or cost segregation, and I am personally intrigued about Deferred Sales Trust. And I know you and I have talked about it, and I think there will come a time where I'll do it.
Yeah, and we've seen that it's certainly a time and a place for everything. A time and a place to be into debt, a time and a place to get out of debt, a time and a place to use the 1031, a time and a place to use cost seg, and a time and a place to use the Deferred Sales Trust. Most of our clients today are baby boomers and looking to retire from the toilets of trash to liability, and they're not necessarily in that creation mode. They're more in that preservation mode, and they're more looking to free up their time and their energy. However, that being said, we certainly think Corona will change some things, because a lot of my clients at this point are sort of like wait and see. Like, I don't necessarily want to be a buyer right now, and if I can park on the sidelines and wait tax deferred and redeploy at a different time, then yes. So we do sense this window where we're saving multiple failed 1031 exchanges to do just that. But that being said, are you ready for the lightning round?
Sure. All
right. So what would you say your maybe your favorite leadership or business book that you've read recently in the past few months, or it could be all time list?
I would say Rich Dad Poor Dad was one that got me started in this. That was a long time ago, though. A few years ago, I've read a lot of Malcolm Gladwell's work, Tipping Point, Outliers. I think that was another. I would say those kind of really stand out.
Excellent. Maybe a favorite leadership quote. It could be from one of those books, or it could be just in general.
That's actually a personal conversation I had with the CEO of the first company I worked for in Silicon Valley. He basically said, and this is around the dot-com boom bust times. I was a young engineer, literally a year out of college, very insecure about what was going on. And he told me that there's two things, value and valuation. In great times, valuation is more than intrinsic value. And in bad times, valuation goes below true value. And over the long run, they generally converge. So don't focus on valuation, focus on value, right? In a deep depression, you may have, things undervalued, and in a boom time, you may have them overvalued, but focus on value, not valuation.
Love it. Worst real estate deal ever?
I'm going to knock on wood here. I've never had a losing real estate deal, but I would say the least best deal was my first ever single family purchase in Arizona. It ended up okay, but I would say I learned a lot from it. So it's tough to call it worst, but since we're talking about dollar signs here, that would be it.
And you're probably really glad you went to multifamily pretty quickly after that, right? So you could scale,
Yep.
And you can get better leverage and get, all kinds of neat advantages that multifamily, multiple units allows you to have. Excellent. Maybe best real estate deal ever?
I would say that was probably the deal you sold me. That was the 100-unit property I bought through Brett in Sacramento area 3 years ago.
Yeah, and that was a value add. About 50% it was kind of renovated. The other 50% was kind of the meat on the bone. And
Yep.
we found it off market, and I was able to represent both sides and make a fair deal. And my client who was selling had an up leg lined up, and he did a 1031 exchange. So yeah, I think that was a win-win for everybody, and I'm so glad it worked out. So this is the last question, and my favorite question of actually probably the whole list here, and it really is centered around how you personally stay centered in your values, right? After all your success as a tech entrepreneur, as a real estate entrepreneur, as a leader on your company and for your family, and all of these things, how do you, Kanwar, stay centered in your values, and then also how do you stay encouraged to reach for new goals?
Yeah, that's a great one, because I think when you really deep down think about what matters to you. And that takes a little bit of thought. And that's, for me, number one, health, number two, family. And I'm not saying that it's number two, it's really 1.1, because if you're not healthy, then you have nothing else, right? So it's health and family, friends, and everything else. And money comes and goes, and many things will come and go. I think those are the really the key things that matter to me. And then the other thing is what I can do to help other people. We touched on that a little bit earlier. I try to focus on identifying opportunities, organizations, individuals that I can mentor, that I can help, that I can go out of the way to help, because in the end, nobody remembers individual things, little things somebody did or said. Generally, people remember how they were made to feel or how they were helped, right? And that's generally the feeling people walk away with. And I've had the good fortune of having had people that have helped me, between family, colleagues, mentors, and then I'd like to do the same to others. So really, it's about what gives you true happiness. The things that make me happy are actually very, very simple. So that's really what I think about in down times, which thankfully have been rare, but it really keeps you grounded.
That's beautiful. Yeah. Family, health, and friends, and helping others, serving others, giving back. And those are all beautiful values to have, and ways to approach it. So Kanwar, we're going to, where can people find you if you want them to find you, or anything that you want to plug, you can right now, and up to you. And if not, that's okay too. And just give the last thought for the listeners.
Well, I'm easily found on LinkedIn. I'm not a huge social media person, but I'm a big LinkedIn person. So I'm easily found there. And I think the thing here, that we can all learn from, as we are learning every single day, is the world is a complicated place, and even this coronavirus thing it's shifting every single day. It's very fluid. It's developing day by day. It's very difficult to model. Even now we're learning things we learned from the Chinese numbers are now apparently no longer true. If you think about it, how can a country that's 5 times the size of the US, which were completely caught off guard, didn't even know what this thing was, only lost 3,500 people? That's just not possible, right? That's my smell test. Again, everybody can draw their own conclusions to it. So I think being curious, being inquisitive, being thoughtful, and always being a student, I think was what I've strived for, and I think that's what society should strive for. And then again, being able to help people, so that there's something you can give back. Because the only reason I was able to go to college is because of the federal subsidized student loan program, right? But my student loans were a much higher interest rate, different time, different era. But, so there are things that I will always support, because I realize that there are a lot of people who wouldn't ever have a chance without them. So again, I think it's take some, give some, generally give a little more than you take.
Love it. That is so encouraging. And I want to thank you for sharing your wisdom, your deal stories, the inspiration, your thoughts on what's going on in the technology world, as well as with the corona crisis. And I encourage you to keep using your gifts and your talents to help people and to succeed in business and with your family. So thank you, Kanwar. Thank you for being a client. Thank you for being a friend. I appreciate it. And I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the 1031 exchange, such as cost segregation, such as the Deferred Sales Trust is the best way for you to grow your wealth. I encourage you to share, like, and subscribe to the podcast. Share this with somebody who needs some inspiration. Remember, you could start at humble beginnings and work hard, be a student, and give back, give more than you take, and you can succeed on so many levels. So thanks again for listening, and we look forward to having everyone else listen on the next podcast. Thanks so much.
Thank you. Thank you all. Thank you.